Okay, let's get started. It's 11:02. First of all, thank you for joining. Welcome. Assalamu alaikum.
Mm,
We're
so,
bringing this first session as part of AgileUmmah, the idea behind AgileUmmah, and hopefully there's a lot of people from JM, Just Muslims community. The idea about JM, AgileUmmah was my idea that, for those who know me, the work that I do in the community, I wanted to do something more. There's never enough that we can do. So I wanted to dedicate and obviously foster knowledge throughout a concept of a global conference of webinar, right? So think about the iknas and the isnas of the world. Obviously, those are more specific to the religious discussions, but I want to kind of broaden that information and knowledge beyond that, right? Whether it's technology discussions, finance, law, medicine, real estate, social services, leaderships, marketing, education, right? We have so much wealth and great speakers and businesses in the ummah in the community that I want to bring empower the ummah by sharing that type of information. Right? It's not only about technology, but it's also beyond technology in most of the technology people that we live in. So if you know of any businesses or individuals that you feel might be able to come in and present in any of those areas that will maybe benefit the larger community, please reach out to me. AgileUmmah at Gmail or imtiazfazil at Gmail is the email address. So we'll set up new sessions. You can obviously follow us on Instagram, YouTube, and LinkedIn as well. Working agreements, rule for the session. I want to make sure everybody's muted, please. Hold questions till the end. Like I mentioned in Zoom, raise your hand in Zoom, and I will call out your name in the order that I see best. Just have some patience. We have a decent crowd today. And the session will be recorded. I was debating about this, but I'll try to record it. It's already recorded, so I'll try to put it on the YouTube channel. No commitments, no promises, but that's the intent. And then, as I mentioned, the information for the speaker will be shared. And then please refrain from any self promotion. We want to kind of dedicate this time to the topic that's on hand. So we'll do quick introductions, brief presentations, and then we'll go into Q&A. So for those who maybe know me or maybe don't know me, my name is Imtiaz Fazil, and in my professional role, I actually had an agile practice for a Fortune 100 company. And within the company, I might be also be known as an agile subject matter expert. Um, a small part of work that I do as my way of giving back to the community is always related to career guidance, mentorship, and teaching in this space. I find immense satisfaction in meeting people, witnessing and hearing stories of individuals' successes and their growth careers, perhaps from the little knowledge that I may have shared along the way. A brief introduction for today's guest, Usman from AMS Tax Offices. He is based in New Jersey. Usman is an MBA gold medalist, is a certified acceptance agent, an enrolled agent. His practice has been established since 2010, and he is authorized to practice before the IRS in all US 50 states. Usman expertise spans personal and business tax filings, accounting, payroll, sales tax, IRS audit representation, and tax planning. With a knack for company formation and structure, he brings versatility to handling finances across the industry. Usman is an expert known for minimizing taxes, which is what all we want, maximizing refund, again, what we want, and providing strategic financial planning for individuals and small and medium businesses. Today, he'll share insights on navigating the complex world of taxation. Ladies and gentlemen, please welcome our distinguished guest, Usman. Okay. All right,
thank
Usman, I am going to make you a share mode. So give me 1 second
you.
and I will make you the presenter. Okay, I am going to stop sharing. See if you can share your screen, Usman.
Just a second, I'm going to share that.
There we go. And just make it as a presentation mode if you want.
Yeah, I'm going to do that. I'll just move all of these things. Okay, thank you very much, Imtiaz bhai, for making this effort to bring this session to the community. And I'm also thankful for a lot of people I see that are joining, taking time out to attend this session. I know the tax topic is always a dry topic. I'll try not to bore you guys, and I'll bring some good tax tips that, inshallah, everyone will have some benefit out of that. So you've already given the introduction. My name is Usman Siddiqui, and this tax practice that I have since 2010. Um, I did my MBA from Bahauddin Zikri University, Multan. I'm the gold medalist. I have the background in finance and IT both. So I did my EA back in 2010, which is a federal authorization that you can represent people before IRS in all 50 states. So as you've already explained that this is the personal and business taxes and with reference to all that, whatever a business requires. So I'm not going to go deep down on that one that you can share later on. That's fine. So let's move to the topic basically that everybody is here for. So um, let me see if I can move the screen. Can you move the screen?
Usman, I think you're sharing, so you just have to go down to the next screen.
Okay, I think it's taking a little bit time.
I see the next screen. It's the formation. Is the formation of 2020, 2010? Is that the slide you're
Yeah,
in?
this is the screen, and then there's the next screen.
Okay, so why don't you um you want to stop sharing? I'll share it. If you want to any minor changes that you did, you can just speak to
Yeah,
it.
yeah,
Is
no
that
problem.
let me do that.
There's no much changes. It's just the flow. So I'm
Okay,
gonna
so
stop here. So please share it.
yeah, let me do that, guys. Sorry about that. Quickly, let's pivot in the true agile way, right?
Yeah.
We have to adapt. That is my slide for you guys, and I am going to share. Okay, you should all see the slide. The next slide is the most common.
Yes. So, I want to focus on the area where a lot of our community is, right? Most of the people in this community are anywhere, like in US, if you look at that, a lot of people have W-2s, and most of the people are working on wages. And the biggest question I get every time is, oh, I'm on a W-2, how I can save my taxes? I said, yes, I know that there are limited options available for this community, but let's say whatever is available, at least we should be aware of that, right? That's the most important thing. So I'm gonna walk you through with those areas, those are available. And we'll discuss a little bit that even I know that a lot of this community is already aware of these areas, but the point is that you should have a full knowledge on these areas, so you should be benefited out of that. The first thing is on these all W-2 people, they have health insurance through the employer. And maybe people are aware that there are plans called HSA, which is health saving plans. And I'm not going to go deep down on that one, that who should choose those plans or not. But like there is one option available for W2 people that they can opt in for health saving accounts, and they can push some money, which is a pre-tax. And the good thing is you can use that amount anytime. There's no restriction. You can use that pre-tax money for the medical purposes. And one more good thing is you can use this money for the investment purposes as well. So that's, maybe people are not aware. You can accumulate that over some period of time. And once you have a good amount of money sitting there, you can look for different kind of investments. You can roll over into the different accounts where you have the leverage of putting for the investments. And as you look at the amount, right, for a married couple, it's more than 7,700 this year, which is basically a little more than the IRA contribution that somebody can do. So this is a good amount. Also, next year it will be going up about $8,300. So this is one area where you should look into that. And if you are doing that, you can have a little bit good amount of saving by keeping in view that you are on a W-2. Okay. Let's look at another one, 401k plans. And I know that maybe 80% of the people are aware that we should max out the 401ks. Yes, we do, but right, it really depends, right? It varies from situation to situation. Everybody has a different financial goal. Everybody has a different financial situation. So currently, whatever the tax bracket you are in, if you're in a higher tax bracket, obviously you're going to push it to the maximum, then you can have some tax deferred savings. But I would say you also need to look into the Roth IRA as well, because normally in the employer offers both 401k plan, traditional, and the Roth IRA. And the Roth IRA is the only account that can have a tax-free benefit. So you really need to see and have a little bit detailed of your current situation, your future goals, and see if it is more beneficial to max it out or just get the elective deferral of yours to the amount which is employer matching, and then have some amount under your Roth IRA. And even apart from this 401k plan from the employer, sometimes all the employers are not offering that. So what other options you have? You can go for the traditional IRA, you can go for the Roth IRA on an individual level. And this topic is huge. I just want to give you a little bit ice tips on that. So you should be aware that you can save taxes while having a traditional IRA as well. Sometimes, depending upon the amount of your W-2, you can also contribute towards the 401k and also can have some traditional IRA. Sometimes people are at a level, they have a huge amount of income even after doing 401k, there is an option available that you can put money into the Roth IRA, but you cannot do it directly. So what you're going to do, you can have your traditional IRA and you can fund that as your individual account, and that will become a non-deductible IRA. And that non-deductible IRA can be rolled over into the Roth IRA, which is we call backdoor IRA. And apart from that, there's a mega backdoor Roth IRA as well. If required later, if you need more information on these topics and want to have a separate session only for this topic, I can walk you through. But the bottom line on a 401k is, yes, you should max it out. Everybody knows that, but also you should ponder upon that whether it is right to do the max out on a only 401k traditional, or you should split. To me, most of the time, splitting is better because you're not sure how much the tax brackets will be in the future, maybe higher or like lower, but like at least if you have contributing in both the areas, at least you're not missing out on anything. Okay, I think that's a good enough detail on that. Please stay on the same one. I just finished the B. So let's talk about a little bit more on the C top, which is the pre-tax childcare expenses, right? So for the people on W-2, there's an option available that you can fund money to your FSA for the dependent care expenses. If people have kids under 13, they're going to daycare. Mostly like 90% of the people are aware, oh yes, I send them and I'm going to get a credit. So the credit amount is basically 20% of the maximum $3,000. Last year it was different because of the pandemic, but now again in 2022 and 2023, it is back to the old one. The only thing that I just want to have your attention to, there are two options. One, either you can get the dependent care credit, or you can also put $5,000 in a pre-tax amount that you can utilize for these kind of expenses. So let's suppose like you are sitting in a 22% bracket, which is right after 12% bracket, you jump into 22 when you have an income about $80,000 or more. And I'm assuming that most of the people will be falling for that. So falling under that category. So if you are putting $5,000 as a pre-tax and you are in a 22% bracket, your benefit of saving taxes is about $1,100 as compared to getting 20% of $3,000, which is $600. So you are getting about $500 more. So this is another thing that you should look into that, and if need any help, we can guide. Can we go to the next page, please? Okay. So I'm trying to cover as much as I can quickly about these topics. And as you have seen that these 3 or 4 different topics are about how to put money pre-tax so you can have some tax benefit. But that should not be always the focus. I've seen a lot of times people, especially in a little bit higher tax bracket, you pay a lot of estimated tax penalty. So the estimated tax penalty, because I would say maybe 80% of the people are not aware what exactly and how exactly it works. So you really need to see that whatever is your tax liability in the current year, you must be paying about 90% of the tax liability through your withholdings, which is on your W-2, or by doing some estimated tax payments, or whatever was your last year tax liability, actual liability, you should be paying 100% of that, whatever is higher. And also, if your income is above certain threshold, which is more than 150, then you should be paying 110% of that. So in some instances, this amount I've seen for people comes into the thousands, but for most of the majority of the people, it comes into hundreds. Even if it's $100, right? Why pay additional $100? You just need to make sure couple of things. So you should not absolutely not be paying this. So this is just a waste of money to me. And how we can fix that? The big player in this area is basically the W4. And also I've seen a lot of time people do not make the right choices on the W4. So what happens then at the time of filing the taxes, people have a lot of tax liability, which is a very painful situation while dealing with that at the end of the year. Or sometimes people get a lot of huge amount of refund which causes a lot of delays while processing in the IRS. So I want to pay a little bit attention on this W4 form. When you join the company or if any life event happens, you can always go back to your HR and then you can update this H4. What exactly is W4 form? W4 form is letting your employer know that how they should be withholding your taxes on your W2. So normally I see problem when people have multiple jobs or when husband and wife both are working. So let's suppose that a family of husband and wife having two kids, and if husband is working W4 form, you fill up as merit filing joint and get two exemptions or two deductions. And also wife does the same thing. But what happens? Because when you combine the income at the time of filing the taxes, your withholding fell short. And then you have a lot of tax liability. So you also, to me, when especially you have multiple jobs or you both are working, you can fill up the W4 form as merit filing separately or single and do not claim any exemptions. And most of the time I see this as well that, oh, like it's going to impact my immigration status or it will have any other impact. I don't want to be in a, any situation that I can be get hold of by the federal immigration. Absolutely not, because this is W4 only dictates how the withholding should work. So for a single person also, no exemptions, even if you have more kids, put less exemption, let them take a little bit more. So you should not be in a bad situation at the time of filing the taxes. So this is a really important thing where people should pay attention. We can move forward a little bit and see what is next. Yeah, deductions, everybody is aware that we can take either the itemized deductions or we can take a standard deduction. So since Trump has introduced this Tax Cuts and Jobs Act in 2017, after that, what happened basically, exemptions amount have gone, the standard deduction has gone up, and a lot of people, those were taking the itemized deduction. When I say itemized deduction, you have 3 or 4 different portions. One, the biggest is basically the taxes, the real estate taxes that you pay on your properties, the mortgage and trust that you pay on your property. If you have medical expenses, you can take a little bit portion out of that because this is a very different um, a difficult deduction that you can get, because like 7.5% of your AGI, and after that, whatever is above that, that can go towards your itemized deductions. And also the charitable contributions. If you add up all of them, now in this current situation with this TCGA, most of the people have those deductions less than the standard deductions. So we are left with only having the standard deduction, but all these are different kind of expenses, and these are huge expenses, and we are not getting any utilization of that. So how we can get help, by looking at this? you should have a side gig or you should have a side hustle. So when I talk about it, a lot of questions comes into the mind, and people see that how it can be a situation, right? So I'm going to just give you an example. One, you are working in a particular field. Maybe it is an IT, maybe it is medicines, maybe it is real estate or whatever, right? You can have your own consulting firm that you can build up and start having some activities and do a proper laydown of the business, a structure of the business. Most of the people are currently working from home. You're utilizing your home and all the other expenses that can be written off, all those are regular expenses. You are anyway have all those expenses. And an easy way to look into that is basically if you go and get your annual spending report from your personal credit cards, you'll see a lot of expenses and a good amount of different categories that you can utilize for your business expenses. So if you have a side hustle or a side gig, that can become really handy. And I've also seen a lot of issues in this area because sometimes people say, "Oh, I do have real estate on the side, but I'm not getting any deduction because the real estate losses are the passive losses, and all these passive losses can be just only adjusted against the passive income." 100% right, but there's a way to do that. Even you have these kind of investment, the real estate investment, those investments, first of all, should not be under your personal name. You should have a company structure. Even if you have one rental property, you can have an LLC on the side. You can put that title of the property under that LLC or not. Maybe one is fine. Maybe you have two or three, then you can transfer the title. The good thing of having that LLC on the side is basically giving you a leverage of utilizing all the operational expenses. As I explained, all these expenses are there, right? So some portion of those expenses are 100% legit expenses that can be written off. And those are operational expenses that will basically offset your W-2 income. So, and one more thing, even if I've seen people started on a side gig on the side, but at the end of the year, that becomes a huge amount of income. And, in this situation, when you're doing something on your personal name as a sole prop, and you end up having a lot of income at the end of the year, we cannot avoid self-employment taxes. And if you have a structure laid down already, like an LLC, and if you are doing something and you come up with a lot of income at the end of the year, there are a lot of ways to handle and reduce your tax liability if you have a side gig, which is registered. So my idea over here on this one, that can help you a huge amount of reducing in taxes. So lay down the structure of an LLC and have your side gig registered and do some efforts and keep some good records. But definitely it's gonna give you a lot of benefit. Okay. Our next topic is the capital gain and losses realization. So
Excuse me. I have one question.
sure.
Um, what if we use a trust rather than
Brother
an
Naman,
LLC?
Naman, I apologize to interrupt you, but can we hold the questions for the end, please? I've noted your question in the chat. We'll get to it. Thank you. Appreciate it.
We'll get back to that one and I'll, whatever the questions are, we'll attend those as well. So the capital gains and loss realizations, right? So in this, what happens? A lot of people have a little bit confusion. Most of the people may be aware of that okay, if you have losses in your capital gains, you can write off against your capital. Your losses can be written off against the capital gains. But if you only have losses, there's a limit. Like if a married couple is filing and if you have losses more than $3,000, that $3,000 can be written off. But if you have surplus, that can be carried over, and the confusion comes into the picture at this point. If I have a $10,000 um, capital losses, I'm carrying it over, and if next year if I don't have any capital gains, then out of the remaining, I can still write off another $3,000. But let's suppose if you have a capital gain next year. So all that carried over losses can be written off against your capital gain. So And next year, if you have $7,000 and if you have carried the $7,000 losses, so all that will be offset and then you're not paying any bill. So that's why realization of those capital losses is also important. And there are some myths about having these realizations. Sometimes people say, okay, because the wash sale, you should be aware that if you are selling something at a loss, you should not be buying the same security within 30 days. Otherwise, IRS will term it as a wash sale and you'll not be able to write off that, right? So some ideas people have around that. If husband is selling and wife has a separate account, so wife can buy it another account. Um, a lot of people can get away with that, but it's not a right strategy because IRS is looking into that, and then eventually, either in a year, a couple of years, 3 years down the road, it will be figured it out because it is not allowed. And then you have to pay back all the interest, taxes, and everything, right? So you should be avoiding that. Second thing is sometimes people say, okay, I'm gonna sell it over here and I'll buy it under either a tax advantage retirement account or under my corporation. Again, these both are not the right strategies, and you should be aware of that. Now, the third thing is the real estate, right? Sometimes people say, okay, I have all these different losses that I'm getting on my real estate and I'm not getting any help. So one idea that I have provided is you should be covering all that under an LLC. So LLC has separate portions. One is for your operational expenses and where you are managing your real estate. That real estate have some passive losses. So they will save the passive losses will stay the passive losses, but the operational expenses under this LLC will help. But all these passive losses that you are carrying over, you should be aware. So let's suppose every year on the tax return on the piece of paper, right? Normally, all these real estate has losses. So even let's suppose you have $3,000, $5,000 losses. Fast forward like 5 years, 10 years, you are keeping that property. So all these accumulated losses, maybe after this time, you have $50,000 losses. So when you will sell this property, and if you have a capital gain, all that carried over losses will be offsetting your capital gain. So that is also very really important point that I just wanted to make over here. So let's move forward a little bit. I just want to pay a little bit attention to the businesses as well, because I know that a lot of community has small businesses, and something new, which was never before under the Corporate Transparency Act of 2020. They were trying to make it, but now, it got into effect January 1st, 2024, a beneficial information, ownership information reporting. The Federal Financial Crime Enforcement Network has laid down this requirement that every company which was active and which was created after 2020, they have time to file this BOI report before the end of 2024. And all the new companies that will be created in 2024 or afterwards, you have 90 days to report or any changes within the structure of the company. You also have 90 days to report. So this is a very important new information, should not be missing out on that. And there are some exemptions, like the companies that have more than full-time 20 employees, or companies that have more than 5 million revenue, they are exempt of this reporting. Anybody needs any help, we can help on this. And the next important part is the structure of the company, which I get a lot, because whenever you are starting a company, a business, you really need to understand what are the structures available, and what structure is basically best for your business. Everybody is aware that there are LLCs, there are S corporations, there are C corporations, but like maybe half of the people are not able to understand what exactly the difference is. When this is an LLC, all these different structures as a baseline provide the protection. The asset protection is there for all of them, right? The only bigger difference comes into the picture, that how the tax treatment of these different structures are, and where you should be aware of that. So you should get a good amount of benefit while understanding that structure. So a single member LLC gives you the protection for your assets, but up till a certain income level, right? You are good with that one because LLCs are not good saving for taxes. LLCs are good for keeping your assets separate and protecting you, and up till a certain amount of net income, because LLCs pay self-employment taxes, which is about 15%, which is a killing when you have more than $30,000-$40,000 of net income. So if it is $50,000 net income under an LLC, you're paying about $7,500 additional taxes. And also, the LLC structure, when a lot of people come with the question that we have more than one partner, then LLC is treated as a partnership. So under this partnership, when this is an LLC, to start a business, this is a good structure because there are less requirements, means the partner or the member of an LLC are not required to have the payroll. They do not have to have the worker compensation for themselves, but they are treated as a general partner when they are actively participating in the business, and they can be held responsible for the huge amount of liability as well. So the next step is when you go to a certain level of net income, then LLCs are not good. So you should transition to the S corporation, where you do not pay any self-employment taxes. You basically just paying the federal taxes, and also you are getting a good amount of deduction on a pass-through income as well. There's a lot around the S corporation because I know a lot of community is doing consulting. And in a consulting world, basically you're doing a corp to corp, you're providing services to your vendor directly, and then they are billing you, you are getting that income into your company. There are a lot of ways and means that a lot of tax planning can be done around this topic. I'll explain a little bit more on these. Um, the structure from S corporation to the C corporation. A C corporation is totally an independent, isolated structure that has nothing to do with your personal. You can have basically dividends out of the C corporation when you see that it is a right time to do that. A little bit question that I have, a lot of people also ask that this is a double taxation. Yes, this is a double taxation. This structure is not 100% fit for everybody, but there are situations where this structure can be laid down, especially when on a little bit on a bigger scale. Because companies going public cannot have an LLC and S corporation. They should be treated as a C corporation. And also the C corporations can lend the money to its owners and keep the retained earnings. Um, and the basic thing between all of them is when you are starting a business, you should have an LLC. You should be avoiding a sole prop because, as I said before, when you grow from a zero to a certain level, and if you only have a sole prop and you didn't register the LLC, there is no other way to save on the taxes. If you have an LLC in the beginning, then there are a lot of ways that we can handle your good amount of income at the end of the year by treating that either an S corporation or so. And with the S corporation, I'll explain a little bit more a little later. So I just want to pay a little bit more attention on the other areas when you have your own business. Our next topic is basically a lot of these businesses, even it's the consulting services, right? If you are providing your IT consulting, other kind of consulting, and if you have kids either under 18 or over 18, and if you want to employ these kids under the business, this is a beautiful strategy. Also, maybe a lot of people are aware of that and know that, but how exactly it works, you should be aware of that. So for that matter, basically, if you have an S corporation, you cannot employ kids under your S corporation directly, then you will be subject to paying Social Security and Medicare taxes. So we really need to lay down a separate structure. We're going to create a separate entity normally called Family Management Company. So that Family Management Company, LLC, you can employ your kids under that, and your S corporation can hire this company. The beautiful thing about that is, especially when the kids are 18 or under, when you are paying them, you can put them on the payroll, and you're going to keep their payroll below a certain amount, which is actually this standard deduction. For the 2023, this standard deduction amount is huge, which is about 13,800. And we are keeping the payroll for these kids, those are especially with like 16, 17, and 18. And when you have $13,000 payroll, you're not paying any federal taxes. As a company, you're not paying any Social Security or Medicare taxes. And kid also is exempt from paying the Social Security and Medicare taxes. So just imagine like if you have 2 or 3 kids at the age of like 8, 9, 10, right? And if you are putting like 7, 8, 9, $10,000 for each of them, there's a $20,000. So that $20,000 is coming out of your S corporation as an expense. And if we are putting these kids under the payroll, this $20,000 is not generating any absolutely zero federal tax liability. And the next day you're getting this $20,000 either into your own account or maybe your kid's respective account. And the good thing about that is this is an earned income. And when these kids have earned income, you can go and open a Roth IRA or a traditional IRA account for them. So let's suppose you are starting with an age of 7, 8 years old, and if you are just putting $5,000, $6,000, and every year you are doing that $6,000 to $7,000 into your Roth IRA account, by the time they'll be 16, 17, they have a lot of money sitting for their investments. And the beautiful thing is they have that Roth IRA, and which can generate a huge amount of income later in the game and without paying any taxes. So that's why I just want to pay a little bit attention on this part. So everybody should be aware of that, how you can employ your kids under the business. And if they are over 18, you can also employ them. You don't need to issue them a W-2. You can have them on a 1099 maybe. And then also, because if they are involved more into the business and you are sitting in a higher tax bracket, a good amount or a good chunk of your income is going from your business to them, obviously their tax bracket is way below your tax bracket. So just you're sitting in a 32% or 35% bracket and they are in a 12% bracket or maybe 22%. Still, there are like 10 to 15% tax saving on this kind of a situation as well that can be laid down, structured according to whatever your situation is. So that's one good huge topic was that gives us a lot of tax savings. So next is our auto deduction, which is also huge. Since Trump has came, he has made a lot of these different kind of deductions available for especially for the businesses. So before that, there was Section 179 that was and still available for any kind of equipment, even if you have software that you have purchased, any leasehold improvements internally in your office that you have done can be written off under Section 179 or a bonus depreciation, especially the auto. Why I say auto? Because, this is the most common thing. Everybody has auto. And if they have a side hustle or a side business or an actual business, this is huge. The bonus depreciation started last year with 100% reduction on your auto. It is 80% in 2023. And then going forward, every year it's going to reduce 20%, and 2026 it will be ending. By that time, I don't know like how many more rules going to come in, and maybe they're going to revive this and do that. But currently, this is huge. And one good thing with the bonus depreciation is when in a legit business situation, if you have a good amount of profit coming in, let's suppose you have a $50,000 profit, and you have got an auto, let's say $80,000, right? So in a first year, even 80% deduction can give you about $68,000 deduction, which is more than your net income. And the good thing is when you have a bonus depreciation, even if you have losses, you can have these losses under Section 179. All this depreciation deduction cannot give you the losses. So in that situation, when you are getting it under Section 179, if you have the losses, either you have to carry back or you have to carry forward to offset them. But in a bonus depreciation situation, you can offset your income. And if you are having losses, because all these losses are operational, and if you have a day job and if you have W-2, these operational losses will offset against that W-2 income. That's why it is huge and gives a lot of benefits, especially when I see a cop-to-cop situation. The next thing on these auto is I just want to pay a little bit more on this one. The actual and the standard deductions. The actual is basically the actual amount of expenses that you can write off. And IRS has given another method we call standard. Standard means you can get a standard number of mileages. Every mile gives you for this year around 65 cents. And the only thing that we need to be aware of that, okay, when should I get an actual or when should I get a standard? So the businesses will do a lot of mileages, especially the limo services or the delivery services businesses. We should be looking into the standard part. And if those businesses are not there, you're not running a lot of mileages, then actually we should be getting an actual, because in actual deduction, we will be able to take the depreciation and we will be writing off like the gas, the insurance, then repairs. In standard, you're not able to take off the insurance, repairs, and the gas, but you'll take the standard deduction. So with respect to the type of the business, we should be choosing wisely that which is better for the business. Okay, now let's move to the next one. The most important thing with the businesses, I have seen people involved in the businesses, they are too much involved in the businesses and they don't pay attention to have the proper track of their expenses, okay? They are using their personal account, they are using their business account, they have 10 different credit cards. The vital thing to know is you should be very vigilant that, okay, what exactly going on into your business? And unless you'll have a proper tracking of all these business expenses, you'll not be able to identify where you are spending when it is not required. And that can be done pretty easily. You can just have, download your transaction, dump into an Excel sheet. Everybody as an IT person or maybe a very well versed with Microsoft Excel. So they can have a little bit, structured way of managing that one that believe me, that really helps. And a lot of people are not doing that. There are other services available that you can download the software like the Money or the QuickBooks or anything and get that can give you nice reporting as well. And that will really help you. And also, one more thing that I've seen is like at the end of the year, you really need to see either you should shift your income expenses because that can make a lot of difference. Means if a huge amount of income is coming, so you can talk to your vendor or customer or whatever, and you can make some arrangements that, okay, either you can push this to a next year, or maybe you can get half in this year and half in next year. The same way, you can make a decision towards the end of the year, should I have this big expense this year or next year, right? So if this year your income is not huge, and even if you have bought a new car, you should not be writing off that car in this year, because maybe if you are expecting that you will be getting a good amount of income next year, even let's suppose you bought a car in 2023, and if you don't have enough income in 2023, even if you bought the car, you should keep it for 2024, because for the bonus depreciation, it's not only the new car. Even if it's a used car, you can put in the business in 2024, and the same car, you can have a huge amount of deduction in 2024. If you are perceiving that, you will be getting a good amount of income in 2024. So this is another topic that you should be, looking into that. Our last area, which is also, as I said before, huge, the solo 401k plans for the business owners. So like in a consulting or any other kind of a services, especially when you are the owner or wife is the owner and you do not have any other employees, this is huge. You can have your W-2 and you can put a maximum of your own elective deferrals, which is basically, that was 22,500 for 2022. Now, sorry, for 2023, and then going forward, it will be $23,000. So you can have a payroll, you can push $23,000 towards your solo 401k. The good thing about this is, as you are your own employer, your own company can give you a 25% match. So just look at the difference between a W-2 job where you can get about 4 or 5% or maybe 6% max employer contribution under your own business, right? You are your own employer and you can put 25%. And we really need to see, because the limit is high, that you can put your solo 401k plan about $68,000. To reach that, you really need to put your W2 on a very high level. We really need to find a sweet spot that, okay, what amount of W2 should be good, so I can get the maximum on my side, and also I can get a 25% match. So this can give you a huge amount of deduction, because whatever his employer is matching, you are writing that off as a business expense on your business tax return. And also you are getting a good amount of income, not income, basically a good amount of contribution towards your solo 401k plan. The last topic that I want to touch is self-directed IRAs. So also, maybe a good amount of community is aware of that. What is a self-directed IRA? And the biggest problem with either W2s or other people, the mistake that I've seen, whenever we change the job from a previous employer to the new employer, we normally move our 401ks from the previous to the new one. Please don't do that, please. The reason behind that is, when you move the 401k to the new employer, then you're stuck again. Your current employer will not let you take the money distributed out of that account. And if you can just get maybe 50% of that, or just get a loan of that. So the good thing is, if you keep it separately, you can roll over into a self-directed IRA. The self-directed IRA gives you the flexibility and leverage that you can invest basically wherever you want. And that investment can be, in an operational business as well, a rental property as well. And then, you can have some partnership with other people as well. They have also the self-directed IRA accounts. And there's a lot can be done under the self-directed IRA. And a lot of people have built a lot of wealth under that, which is a tax deferred, not tax free. But again, as I said, you can have a combination of traditional IRA and the Roth IRA that you can utilize, and you can have a lot of benefit. So all of these different good tax tip topics are there. I can only touch upon with this 1 hour, but if anybody needs any help on that, I can definitely help and provide more details on this one. And anybody has any questions?
Okay, so with that, let me just do a quick housekeeping stuff. The whole tax thing is not that simple. It's obviously complicated, and
Yep.
somebody like me, I have a lot of questions individually. I'm sure you have your individual use cases, so 1 hour can never do the justice. But in the classic agile time, right, we have to time box everything. So it's a 1 hour session. On the screen, you have the information for Usman. So please capture that as well. And let him know that you came from AgileUmmah session. So this way he can identify where people are reaching out to him. There are almost 80 people on the call. So we will go through the questions I received in the order on the chat. If we get to most of them, that's great. We can spend extra 5 hours here if needed. So keep your questions coming and I'll go through them in the order, okay? So the first question Usman received from Mujahid is, can we have HSA without high deductible plans?
No, this is basically the requirement of having an HSA, that you have to have a high deductible. And this high deductible is not like about $2,500 to $3,000. You can look the plans. Normally, employer have a good amount of different variety of plans that you can opt in. But as the basic question, can we have an HSA without having a high deductible? No, you have to have a high deductible plan. And even if you have that, right, the good thing is, you are not paying anything right away. You're not paying your co-payments, and even the bill that you will be getting from service provider, that is an agreed upon between your employer and the insurance company. That is not a top dollar that you are paying. That is also an agreed upon a reduced amount of basically bill that you will be getting.
Okay. Next question came from Sadia. She was asking, what is suggested 401 or Roth IRA?
As I said, the 401, right? So 401 at employer place, you can get that 401k plan. And under that 401k plan, you can have two different flavors. One is called traditional and one is called Roth. What traditional does, that is basically pre-tax, means you're not paying any taxes on this one. So once you opt in for that one, you are not paying any federal taxes on that portion. So you are getting a tax benefit right away. It means you're not paying taxes for that portion. For the Roth, if you're opting in, that's a post-tax, means you're already paid taxes, but you're putting money into the Roth. We really need to understand the difference. One is the tax benefit, which is for the traditional is current. Roth, it will be later on because you will be having a tax-free income out of that. And for me, that I can suggest for everybody, if you can, basically, if you can split half and half, that will be in a long run, you will be benefited out of both.
Okay, thank you. Ahmad asked the question, can we do backdoor Roth IRA from SAP or IRA?
You can definitely do backdoor IRAs and simplified employee pension plans, which is a SEP, or maybe for the self-employed individuals, you can have these all SEP plans. We really need to understand the concept of backdoor IRA, right? And we should not be mixing it out, this backdoor IRA with like SEP IRA or a 401k or anything. What exactly is the backdoor IRA? Backdoor IRA means you are at a certain income limit, and also you have already contributed to these different accounts. So then you are not allowed to put money into your Roth IRA, right? So then we have a way of doing that. That's we call it backdoor IRA. So backdoor IRA means the front door is open. You're gonna go back, and then you're gonna put money over there. So how it is allowed? First of all, this is a two-step process for the backdoor IRAs. First, you need to put contributions in your individual traditional IRA, which will become a non-deductible because of all these limits. So once you have a non-deductible traditional IRA, then you can roll over the same amount from this account to your Roth IRA account. That is called backdoor IRA. And like people with a higher amount of income and all that, they really want to put money into the IRAs. And because of all these limits, they cannot do directly. That's why this is another option that you can do. And once you have a good amount of money over there, you can obviously use for the investment and have a tax-free when the time is right.
Okay, Shah Rao asked the question, any income limit to contribute to Roth IRA?
Yeah, like income limits are different for like personal, a single family and a business, sorry, not a business, for the married couples, right? So these limits are for the married couple is, I don't exactly remember everything, but like it is about $200,000 as a married couple. If your income is beyond that, then you'll not be able to contribute into the Roth IRA. So that's the reason you can, follow if you've already contributed to the traditional IRA, or you've already contributed towards your job's 401k. So then you can put into the traditional and you can roll over into the Roth if you're beyond the limit.
Okay. Mujahid asked a question, can we contribute max out to 401k and traditional IRA both?
You see that IRS allows and have certain limits. If you are maxing out in your 401k, then most of the time you will not be allowed to contribute into the traditional IRA. And this is a perfect situation. When you have maxed it out at a 401k at the job place, and now if you are putting money into the traditional IRA, you can do that. But this situation, in this situation, you will have this traditional IRA contribution called as non-deductible. Non-deductible means you are not getting any tax benefit out of that. So once you have a non-deductible traditional IRA contribution, you can roll over this amount into the Roth IRA, which is actually the backdoor IRA.
Okay, thank you. The question that was asked earlier by Noman was he wanted to find out what about trust rather than an LLC?
Yeah, like again, there's a huge difference, right? LLC is for an active business, right? Trust is not saving on the taxes. Trust is actually for the protection. So once something is, let's suppose why we make a trust, your assets, like your primary home, you can put your primary home under your trust, and at least it has to be there for at least 2 years. So God forbid something happens, so nobody can come and touch whatever is under the trust. So that is safe for your family, kids, and everybody. So trust is mainly formed for the asset protections, while LLCs are basically having some write-offs against your business. And there are other kind of trusts as well, that the foundations that you can create for getting the charitable write-offs. So those are different kind of trusts, and if you need more detail, we can maybe have another session on much more detail, because this is a huge topic.
Sure. Okay, a question was asked about what is an example of real estate losses? Does it only come when the property is depreciated?
Real estate losses, right? This is a good question. Real estate losses are not only generated when you have a depreciation. So let's suppose you are not having a depreciation, or you do not want to have the depreciation on your property because you already have a good amount of expenses, right? So your rental income, for example, let's say $24,000, and you got this property and you are paying the mortgage interest. The rates currently are very high. So you will be shelling out a lot of amount in the mortgage interest, and then the taxes. If the property is in a good area and it has a lot of real estate taxes, you can take the write-off on the entire amount of taxes. It's not that on a personal, as on a personal level, the itemized deduction has a cap on the taxes, which is um, about $10,000, which is we called SART, state and local taxes. In a rental, a real estate world, whatever the amount of real estate taxes are, you can write off the entire amount. So let's suppose $10,000 taxes and another $12,000 mortgage interest. Then you have insurance on the property. You may be paying some HOA. You are going and checking on the property. You may have some repairs on the property. So you are end up having about all these different expenses at $29,000. So as compared to $25,000 rental income, you have $4,000 losses. So these losses are again passive losses. So you are not taking in this situation any depreciation, but you are still generating some losses in this. And these losses, as I said, will be offsetting your passive income. If you don't have passive income, they will be carried over, and you can keep them carrying over, accumulate them down the road 10 years. Even if you sell the property and have capital gain, you can offset all these real estate losses against that.
Okay, thank you. Okay, we have a few more questions. I know we're up on time, but I'm going to continue asking those for
Sure.
the benefit of everybody else. So, you mentioned about capital gains tax for selling homes. If there is equity, what is the best option to work around that? So, you mentioned about capital gains taxes for selling homes. If there is an equity, what is the best option to work around that?
Yeah, you see, capital gain and equity, these are two different things, right? Even if you have a lot of equity into the business, or if you do not have a lot of equity into the business. So what will happen with that when you are selling it, right? When you are selling it, either, if you have a lot of equity, that money you are getting it. If you don't have a lot of equity, you will be getting a certain portion and the remaining will be going to the lender. So this is one part. Now, the other part is the capital gain. The capital gain is, if it is a primary home, you also, as the topic is, so if it's a primary home, then up till $500,000 capital gain, you're not paying any taxes if you are keeping that home 2 years or more in last 5 years. We are talking about the investment property where you are getting the capital gains. So if you are getting, if you want to avoid the capital gain taxes, there are 1031 exchanges that you can utilize. And you should plan a little bit ahead that, okay, how I want to utilize this money. If you are getting a good amount of capital gain, so you can utilize that to buy another property or maybe multiple different properties by utilizing 1031 exchanges. So I hope I have clarified that, because there were a combination of two different
Yeah.
things, the equity and the capital gains.
Okay, the next question is about related to probably employing kids under LLC. We all want our kids to work hard for their money. So the question was asked about, is it also true for LLC? I think you mentioned about S Corp, employing kids. Is it also true for LLC?
Yeah, it is true for any kind of businesses, right? You can also do for the LLC, but the idea behind that is, if you have an LLC and if you are netting more than $20,000-$30,000, then anyways, this having an LLC is not a good idea. You are already paying additional self-employment taxes, and then on top of that, if we are just keeping that $15,000-$20,000 that we can have, so we can put it under for our kids' payroll. That's why normally in a structure where the S corporation, but yes, if you have just an LLC and have a business and good amount of income and you want to employ your kids under the business, it can be structured. Yes.
Okay, next question related to auto deductions. Is auto deduction only for corporations or also on individual taxes?
The individual taxes, everybody wants everything, which is not possible. Only, itemized deductions are available. And as I said before, itemized deductions is a combination of real estate taxes, mortgage interest, medical expenses, and the charitable contributions. Before Mr. Trump, there was a Form 2106, like unreimbursed employee expenses. Under that, we have utilized a lot. But after that, all these deduction, the vehicle deduction, is not for actually the personal, but if a person have an LLC or a side gig, yes, you can utilize under that on that personal capacity.
Question asked from Noman was, are ASM fiduciaries as well?
No, we are not fiduciaries for anybody. Like if you are looking for a fiduciary to have a trust or something like that, if it's a real requirement, um, we can look into that, but normally we don't provide any fiduciary services.
Okay. Shabir asked the question, can ride-share gigs be done under an LLC, and can auto deductions benefit?
Of course it is, because rideshare, if it's on a business level, right? Like if you have not registered under any business and you are doing as a sole prop and you are doing it as on the side, maybe, okay, I'm gonna just spend 1 hour, 2 hour in the evening, and whatever ride sharing I'll be doing, I'll have some side money. So if it's a good amount of income, yes, still can be written under the sole prop, and all these different kind of expenses that I've explained. Yes, all those expenses can be written off against that. And a lot of people do that.
Okay. All right. Rao asked a question, can children be given 1099 as a lump sum at the end of the year under S Corp, just like an individual or independent contractor?
Yes and no.
Mhm.
When the kids are, um, as I said, above 18, then it is a good idea that they can be given a 1099 out of the S corporation directly. And if they are under 18, and if you are giving a 1099, that can become a little bit questionable. That what kind of services, you need to keep track of all that, and really have to have a good record and reference that what they have done, so you have paid them. You can give them at the end of the year, but again, like there should be a money trail as well, that over the year you have transferred some amount to their accounts, right? It's just not for the sake of saving at the end of the year, I can do anything you want, right? So the good idea is you should not be giving a 1099 for the kids under 18, because you have a better structure that can, get you a lot of good benefits, and it's 100% legit. So why we should be adopting another or taking another route when we have a very good way of getting all these deductions by having in FMC and, writing off all that.
All right, thank you for that. Next question, Hassan asks, we put money in 401k and IRA to save taxes, but while pulling out, we have to pay anyways. So what's the benefit?
Okay, the benefit, yeah, I'm quickly getting the question, quickly trying to answer all of it. So, the benefit is you really need to see the current situation. If you are really in a higher tax bracket, let's suppose sitting in a 32%, 35% bracket, pushing this $22,000 now gonna save you about $7,000 in taxes, right? And then whatever you are putting in a 401k, and you accumulate that for like 2, 3, 4 years. And then if you can roll it over into a self-directed IRA, so you can use that for investment purposes. Obviously, when you will be pulling it out, you will be paying taxes on that. So that's the whole idea. Pushing that money towards your retirement, so you should be saving taxes now. Later in the game, maybe you are not working at a level that you are, and the concept behind that is, if you are pushing that, the concept is like, okay, in your retirement time, you will not be working that much. You may not be in a that higher tax bracket. So at that time, If you are pulling the money out and you will be paying taxes, so let's suppose you are in a 12% and 22% bracket at that time. So you actually save taxes now, 10, 12% over the period of time as well. So you are pulling it out and paying less taxes at that time. That is
Okay,
another
well,
behind
okay,
that.
we'll take one or two maximum questions. We'll wrap it up. There's some more questions for those that are more specific about employees, for kids being employed, and the other example. Just reach out to Usman directly.
Yeah.
The last question, maybe the second last question, is what would be the best strategy to invest HSA amount in the share market?
Okay, so there are a couple of ways. One, if you're putting money into HSA, obviously that's a free tax, right? And then there are a lot of employers that I have seen, they also provide. So you can roll over to that employer provided custodian account, and then you can invest into the share market. This is one way of doing that one. The other way is if you have an HSA, again, you can roll over into a self-directed IRA. So once the money is in the self-directed IRA, then you have the leverage of putting it wherever you want. Like I said before, if you want to put it in the rental real estate or if you want to put it in the share market, the only thing is, again, as far as you are with the current employer, you may not be able to take that money and roll it over into the self-directed IRA. But when you are moving employers, then just leave that self-directed IRA or the other IRAs, so you can move your money wherever you want.
Okay, well, that concludes our question. I know there's some questions that are left out, but again, you have a way to reach out to Usman. I want to thank Usman, obviously, for his time and dedication to spend an hour with us today, educate us. I know it's a complicated topic. For those that joined, the 80 plus people, thank you for your time, your support, your dedication. Again, let's find out if there's other areas in business and individuals that would like to come and present to the community. Reach out to me directly. And for that, have a great week, the rest of the day, and enjoy the rest of the week. Thank you very much. Assalamu alaikum.
Thank you, everybody. Assalamu alaikum.